America's debt machine is starting to sputter, simply because there's no one left to keep buying that debt. And just when Washington needs allies more than ever, President Trump is opening economic fronts against nearly everyone. For several weeks now, the U.S. Treasury market has been flashing warning signs. What began as quiet caution has now turned into a full-blown alarm. Bonds are weakening, inflation risks are mounting, and foreign investors are backing away. Meanwhile, a new conflict in the Middle East is pushing oil prices higher, and that could trigger a surge in inflation strong enough to push the United States back into deep recession. Normally, in moments like this, the world comes together to support the global economy, but not this time. Today, the major world powers are stepping back instead of stepping in. As a result, Treasury Secretary Scott Bessent now faces an almost impossible task: convincing China, Japan, and Europe to keep buying U.S. debt. But with the trade war escalating, tariffs have jumped from 1.5% to over 14.5%. It's becoming harder and harder to keep any meaningful dialogue going. Instead of cooperation, there's confrontation. Instead of economic support, growing pressure falls on ordinary Americans. The warnings are everywhere: rising inflation, an approaching recession, and a world no longer willing to rescue the U.S. economy. Since Trump raised tariffs on countries around the world, including a 145% duty on Chinese goods, global trade still hasn't recovered. Despite statements about de-escalation, many Chinese products are still facing tariffs above 55%, and many others are nearing or exceeding 25%. That means U.S. companies are paying much more for the same goods, and prices are rising for average consumers as a result. Major retailers like Walmart, Target, and even manufacturers like Stanley Black & Decker are already warning that they'll have to raise prices. According to Bloomberg, if tariffs remain or increase, the average American family could be spending an extra $3,800 per year just to maintain their current standard of living. And that's not all. Recent U.S. retail data is cause for concern. In May, retail sales dropped by 0.9%, the second straight monthly decline and the sharpest drop in 4 months. It's a clear sign that Americans are beginning to cut back on spending. And since consumer spending is what keeps the economy afloat, that's a serious red flag. A closer look shows that so-called core retail sales, excluding autos, fuel, and building materials, rose by 0.4%, but that's largely due to a data revision for April. So the numbers aren't nearly as encouraging as they look. It's not just consumers pulling back, factories are slowing too. In May, auto production rose by just 0.1%, and excluding autos, industrial output actually declined. That's not a good sign. In a healthy economy, manufacturing should be expanding. But now we're seeing weakness both on store shelves and on the factory floor. Import prices have remained stable, but a weakening dollar is making foreign goods more expensive. In other words, hidden inflation is creeping in from another direction. All these factors are coming together into one massive warning: the U.S. economy is losing momentum. If consumers keep cutting back and factories continue to slow, much bigger problems could be on the horizon. Now let's look at China. While Americans are spending less, Chinese consumers are doing the opposite. In May, China's retail sales rose by 6.4% year-over-year, a strong gain. Industrial production also increased by 5.8%, although it lagged behind the pace of consumer growth. This signals a major shift. China is increasingly focusing on domestic demand rather than relying solely on exports. And this didn't happen on its own. The Chinese government actively encouraged people to spend, and that strategy worked. Massive online sales events like the 618 Festival, combined with government-issued coupons and subsidies, helped ignite a consumer boom despite global instability. There's a certain irony here. For years, the West demanded that China rely less on exports and develop its internal market. And now, as Beijing finally does exactly that, it turns out China is not becoming weaker, it's becoming stronger. By growing its economy from within, China is becoming more resilient to external pressure. It no longer depends as heavily on foreign buyers, which gives Beijing more freedom to resist U.S. policy. That's exactly why China is heavily investing in technology, semiconductors, and rare earth elements. It wants to become the key supplier of the materials and technologies that other countries cannot live without. And the more successful it is, the less vulnerable it becomes to outside pressure. Just think about it. If China becomes the backbone of the global economy, who in their right mind would risk cutting themselves off from Chinese goods, even in a time of conflict? While headlines are dominated by talk of tariffs, China is quietly playing another game, a currency game. In recent months, the yuan has weakened from 7.3 to 7.1 against the US dollar. It might seem like a small change, but the effect is significant. A weaker yuan makes Chinese products cheaper for foreign buyers. So even if the United States raises tariffs, the prices of Chinese goods in dollar terms don't rise as much as expected. And sometimes they don't rise at all. This isn't just about pricing, it's about survival. A weaker yuan helps Chinese exporters stay competitive and also encourages a practice known as transshipment. That's when Chinese goods are first sent to countries like Vietnam or Mexico and then re-exported to the United States disguised as local products. It's a tactic to get around tariffs. The US is trying to crack down on this, but these schemes are extremely difficult to track. What's particularly concerning is this. In May, the US and China agreed to a 90-day pause in the trade war. The highest tariffs were slightly reduced. The US lowered them from 145% to around 30%, while China dropped its rates to 10%. Wall Street cheered, and markets rallied. But in reality, even these reduced rates are still historically very high. Then, more recently, the Trump administration announced they had a deal with China. But under that deal, tariffs are once again climbing, from 30% back up to 55%. Is that good for consumers? Hardly, because nothing truly meaningful has been resolved. China has not backed down from subsidizing its technology sector. The United States has failed to achieve stronger intellectual property protections. All the key issues were simply postponed. This is not a deal, it's a truce dressed up as a victory. And the clock is ticking. Those 90 days expire in August. If negotiations stall, the tariffs will return, and this time, with double the force. The consequences could be far more severe. Retailers have already sold off their old inventory, which was purchased under the previous tariff structure. Everything new will be priced under the new higher tariffs. This could send a shock through supply chains and price tags in stores. While Washington debates debt ceilings and tariffs, American businesses are gasping for cash. Jeffrey Gundlach, widely known in the financial world as the Bond King, has warned of a looming liquidity crisis in corporate America. One of the causes, in his view, is the tariff system. By law, all tariffs must be paid in full, upfront, and in cash. No delays, no credit. In May of 2025 alone, businesses paid $22.3 billion, money that could have gone toward R&D, wages, or strengthening logistics. Instead, it all flows into the federal treasury. This burden is even heavier against the backdrop of falling demand. Retail sales have declined for 2 consecutive months, and the entire economy is slowing down. People are spending less, costs are rising, and companies are burning through cash faster than they can earn it. You would think that, under these conditions, the yield spread between safe and risky corporate bonds would widen, but it remains stuck around 3%. That's not a sign of stability, it's an underpricing of risk, a calm before the storm, and that's not the end of it. We're now facing a real avalanche of corporate debt downgrades. Analysts predict that starting in July, a wave of credit rating cuts will begin. Bonds worth around $50 billion are expected to be downgraded from investment grade to junk, and for many companies, that's a death sentence. The consequences are huge. When a bond is downgraded, the cost of borrowing often rises by 200 to 400 basis points. Refinancing becomes impossible, and a debt spiral begins. Junk-rated companies lose access to major sources of capital, such as pension funds and conservative investment institutions. And all of this is happening at the worst possible moment. The Federal Reserve is still fighting stubborn inflation and has no plans to cut rates. At the same time, geopolitical shocks are pushing energy prices higher. West Texas Intermediate crude jumped 13% after tensions flared between Israel and Iran. That's not just a scary headline, it's a direct tax on logistics, manufacturing, and ultimately, the price of goods in stores. In this kind of environment, defaults don't happen in isolation. One company misses a payment, banks tighten lending, credit freezes. The cycle feeds on itself. This is exactly what happened in 2008. Back then, the trigger was subprime mortgages. Today, it's junk bonds, tariffs, and inflation. To make matters worse, the Middle East crisis is escalating again. Oil has become a weapon. The fragile peace between Israel and Iran collapsed overnight. Oil prices surged, transport costs spiked, and it's already affecting logistics and food prices, especially in import-dependent countries like the United States. Inflation in 2025 is likely to remain unstable, pressured by rising energy prices, global supply disruptions, and instability in the Middle East. And as oil prices climb, so will the cost of transportation and food. Tariffs on Chinese goods are also hitting the American consumer directly. Core inflation risks getting stuck above 2%, the Federal Reserve's target level, and may even hover closer to 3%. If companies run out of cash and economic growth stalls, the country could slip into a state of stagflation, a dangerous mix of inflation and economic stagnation. And this, in reality, is not the end of the storm. It's only the beginning. If the dollar loses international support and inflation erodes confidence at home, the real crisis won't just be a trade war, it will be a loss of trust. And once trust disappears, recovery becomes exponentially harder. To stay informed on the latest updates, subscribe to the channel and turn on notifications. See you in the next video.